We are not waning on our commitment to fight inflation, and we are determined to return inflation back to 2% target.
Okay, so the European Central Bank met today. It was the first time that the central bank made a policy decision, planned policy decision since the banks in United States and in Europe started experiencing credit issues, problems. There was Signature Bank on Sunday, Silicon Valley Bank last Friday, and then this week, U.S. regional banks came under pressure, as well as Switzerland's Credit Suisse. So we're seeing a lot of pressure in the banking system, and this was the first meeting by European Central Bank. Then next week, the Federal Reserve meets. They usually align their policies. They usually go hand in hand. They were both late on dealing with inflation, and now a lot of people are calling on them to pause their plans for raising interest rates, but that it did not happen. The ECB raised their interest rates as planned, 50 basis points. So it's in the threes now. They have three major rates that they adjust. So a couple things that came up during the broadcast of the press conference. One, highly uncertain situation. They did not provide policy guidance on what they're going to do. They're going to stick to fighting inflation. Their inflation in Europe on average is 8.6%, like 16% on food alone. So it's very high. And the other thing was the word beginning. Take a look.
We are seeing we're beginning to see a good transmission of our monetary policy in the credit sector, as I have mentioned earlier on. I think we have seen a reduction of several basis points, 20 to 16 basis points, depending on whether you look at corporates or households, increase in the credit rates that are offered, and a significant tightening on the part of the banks that are probably assessing and reassessing the risks that they're taking. So this is, in our view, the beginning of an indication of good transmission of monetary policy. This is not the end of it. As you said, it takes a longer time. It seems to have transmitted rather rapidly, if you consider that we decided to normalize our monetary policy back in December a year ago, so it's a little over a year ago, and we are certainly beginning to see in the credit segment the impact of our decisions. Are we seeing dampening demand? That remains to be seen, and how much more does it need to be dampened in order to meet the objectives that we have, which is 2% medium-term target, to be seen. We are data dependent. We're going to really look at the uncertainty fading out, hopefully, and what projections we will be able to operate upon, as well as what assessment we can make at our next policy meetings in May, June, and subsequently.
So that word beginning was really significant because there is a lag time effect between central policy making decisions and the impact on the economy. It's so interesting because even the decisions, even speculation about what the central banks are going to do has an immediate impact on financial markets, stock markets. But in terms of its economic effect on people, it takes anywhere from 6 months to 2 years to see those effects play out. So we're really in a new environment here, and we're going to have to see what happens now. Hopefully, it won't be the economic hurricane that J.P. Morgan CEO Jamie Dimon warned us about last year, but some things have changed, beginning with banking sector, and it'll end up affecting credit cards and loans and individuals. So we'll see where we are from here. One thing to remember is that inflation fighting really shouldn't just be about central banks. It really involves good budgeting by governments. So that's something I hope to look into. Let me know your interest, and please follow the YouTube page as well as the website, globaleconomicreport.com. Thanks.